I'm going to let my partner introduce herself. If you don't know Anna, she's really, really smart and takes this whole team helps me out a lot in terms of different transactions. And what we're going to cover next, I know all of you are tired of the S Corp, F reorg, then you get rollover in cash. I think if you haven't seen it, you're going to see it, or if you've seen it, it's just a repeated process of where private equity comes in. You have a target that's an S corporation, and there's some rollover equity, and Anna's going to go through that. Part of the challenging issues when you represent the S corp, and we're seeing it a lot more, and I mentioned it in our last program, and I thought this was a good segue into it, is you have a lot of S corp shareholders that don't agree on the timing of the exit amongst themselves. Or I'm an 80% owner and I want all the cash and I don't want any of the rollover equity. I want to retire. And in the S corporation, as you all know, that is just extremely challenging. And about, I don't know, Anna, it was about a year ago that an article came out. An article came out from some really highly technical people and said, I know how to get you disproportionate distributions, make it tax-free, and it'll work. And I read the article, and I think I've sent it to some of you that I've worked with before. But now all of a sudden, we're starting to see LOI and deal terms pop up with these types of transactions. And I think we saw, I had one recently, and then you're working on one right now. Where I think you're going to start seeing a twist to this, and the technical issues with it are really complex. And with that, I'm just here to pick on Anna, I think a little bit about what we're seeing, but there is some really highly technical things, but I think you're going to start seeing that in the marketplace more. And it's the use of installment 704C. So with that, Anna, I think let's get going.
Yes, I think as Conrad said, this is sort of the typical structure that we start with. We have so many clients that have put their businesses into S corporations, and when they're looking then to sell their businesses, oftentimes the buyer wants a step up in the assets so they can get those extra depreciation amortization deductions. Because if these shareholders just did a stock sale and did it for cash and equity, presuming there's some rollover in the deal, then they could mix the consideration however they wanted to, as long as it was pro rata at the end of the day. But the difficulty comes in when the buyer wants that step up in the basis of the assets, because then you have to do some form of asset sale, which means the rollover is basically going through the target. And so then it becomes a lot more difficult to allocate out that rollover and the cash in a way that's disproportionate, because like Conrad said, maybe one shareholder wants to put in more equity than the other one, maybe one just wants to retire and they just want maybe a small piece just to continue to be a passive investor, or maybe the two shareholders actually don't get along and they want to have flexibility to get out of the investment later on. And if the rollover is held in the S corporation, then that makes it a little bit trickier. Or as Conrad said, if one retires early or just wants to exit early, it's a little bit difficult to get it out of there.
Yeah, one thing I will say that I've been noticing on this is you would always assume that a stock sale results in less taxes. But I'm asking accountants to run it now because the impact of the PTE and the difference in the basis of assets from Virginia versus federal, because you know how they're not coupled, we're getting some very interesting answers that a lot of times it's better if you sell assets, depending on the type of assets inside the entity and whether you're accrual or cash and the size of the gain. So we've been very adamant about running numbers, and you will see when we do these types of transactions we're going to talk about, we have to work hand in glove with the accountants looking at the computations to see if this makes sense.
So I'll set up an example. Maybe I should have made the numbers a little bit easier to do simpler math, but here we are. So
Anna's a former accountant, so she's like all of you. She likes hard things. I'd have done $100. I just can't do this, but that's fine.
So in our example, our target has a value of 25 million. We saw that our shareholders have a 60-40 split. And the consideration is going to consist of 70% cash and 30% rollover equity in a parent. So it's going to be about 7.5 million. But the shareholders want to receive different proportions of cash and rollover equity. So shareholder 1 wants to get 8 million of cash and 2 million of rollover equity, but shareholder 2 wants to get 9.5 million of cash and 5.5 million of rollover equity. So it's a little bit different than their proportions in the S corporation. And of course, the goal here is that they want to keep that rollover tax-free. That's usually the goal because, as we know, they don't want to spend the money that they're getting in the deal to pay taxes on the rollover. And we've seen that. And again, this is why I think we try to get our colleagues on the accounting side involved, that sometimes even without these issues, that can be pretty close, those calculations. So we always need to keep an eye on that. And of course, the purchaser wants to get a stepped up tax basis. So if we just did a regular asset sale, so the way that oftentimes we may see these structured is into an F reorg, which we'll sort of go into in a few steps. But if we just kind of set the scene and talk about what happens if we just do an asset sale. So if we're getting cash and we're getting rollover, generally that's going to be treated like a part sale, part contribution. So you're going to have gain on the cash piece. And the idea is to have tax-free or tax-deferred treatment on the rollover. And we're assuming here, we always have to do our diligence and analysis on what the buyer structure looks like. So we're assuming here that rollover can be received on a tax-free basis, either under 721 or maybe in like a 351 transaction, but that can't be assumed because I know we've seen buyers either not pay attention to it or maybe try and be a little bit sneaky, or maybe there's a more complex structure where it actually doesn't end up working like that. But in this base case, let's assume that we can actually get the tax deferred treatment on the rollover. So if we just do a basic asset sale and get the cash into the company and the rollover into the company, we're going to need to do pro rata allocation of the gain, the portion of the gain. So shareholder 1, if we're assuming that there's zero basis for ease, if there's zero basis in the assets and there's zero basis in the shares, if we have 17.5 million coming in of cash, then there's going to be 17.5 million of gain. So shareholder 1 is going to be allocated 40% of that, which is going to be our 7 million. And then shareholder 2 is going to be allocated 10.5 million. And so then the question is, well, what do we do with the rollover? If we keep the rollover in the target, then it's not going to be in the proportions that the shareholders want, because they're still going to be holding their interest in the S Corp, which holds the interest in the rollover. So they're basically going to have interest in the rollover based on their ownership, which doesn't get them to the percentages that they want. And what happens if we then maybe distribute the rollover instead? And the key of that is that because we're dealing with an S Corp, you're going to have 311B gain on that. And so you're not going to reach the goal of getting that rollover tax-free, because the S Corp can receive in that first step the rollover. And we checked again to make sure that's 722 or 351. But then if the S Corp were to distribute that, it would trigger the gain in that rollover. So the question here would be, could the shareholders do a mix of consideration of cash and rollover and the mix that they want and just distribute it out to the shareholders? And the answer is no, because you're going to trigger the gain in the rollover.
Yeah, I would say the only thing that if we get 100% accelerated depreciation, if there's a new act, you should do some math about if you trigger the gain and if you're depending on your size of ownership and the rollover entity, well, you get enough losses now to offset it, because that was the other unusual when you had 100% expensing. Again, I always said you need to have to project the losses, because then maybe, well, it's not good for us because then we don't have to pay a bunch of fees, but that's the easy way to do the transaction, right? For all of us there. And then in the absence of that, we're going to start the building blocks of the complexities that we're going through and seeing these deals.
So doing a pure asset sale, unless you have really good tax attributes and a good situation, like doing the asset sale is probably not going to work. Like you may also be in a situation where maybe the shareholder who wants more equity isn't up to 60%. Maybe they have something like 2% or only like a small portion of their cash they want to put in rollover, and everybody else wants to get cash. And then maybe actually doing an after tax or actually distributing, maybe it's not going to be a big deal to them, and maybe they can get, I don't know, bonus stock or something else because to make them whole. But generally this is the issue that we're dealing with, unless you have either some deductions that can offset it or like a particular set of circumstances where the numbers are small enough that you can kind of get around the issue. So what are some alternatives? And I think this is sort of similar to what we were just talking about. What if the company just retains the rollover, or are there other alternatives to get around this? And one option might be, can you just keep the rollover in the company and keep an amount of cash in the company so that the cash part that the shareholders want, you can, when you make that distribution pro rata, you can make those numbers work. But then of course you're only addressing one half of the equation. You're only addressing the cash portion of the equation. They would still have the rollover in the company. It still probably wouldn't be in the proportions that they want it to be in. And similarly, maybe you kind of try to make up that difference with a note. But again, if the rollover's staying in the company, you're still not quite getting to the goal result that they want of having those particular percentages in the rollover. And on a note distribution, you may have to pick up some additional gain. So, having to try to mess around with the calculations, because you may end up with basically a situation where you will have more gain you'll have the same amount of gain to the shareholder that wants more rollover equity, but they're going to end up with less cash, so may not have enough cash to actually pay the taxes on that. So again, the numbers usually don't work if we're trying to just play around with keeping the equity or distributing the cash or doing something like that. So we usually have to look at some other alternate solutions. So one here is maybe personal goodwill, and that again is very fact dependent on the particular circumstances. We had a beautiful set of circumstances in one deal last year where it was two shareholders and they were 50-50 owners and they contributed equally to the business. And so we were able to work with valuators to get a valuation that basically said, well, out of the goodwill that's in this deal, this amount could be attributed to the shareholders and it's 50-50. And that was very easy because then they could potentially use that goodwill to then contribute however much they wanted to directly for the rollover equity. Sometimes it doesn't work out as nicely because again, if you have like a 60-40, then if a 60-40 ownership, then you need to have goodwill that either gives them that also splits the personal goodwill on 60-40 basis, or is going to split the goodwill in a way that when they do contribute that directly to the purchaser for the equity, that it's going to get to the proportions that you need it to get to. And also it could result if one shareholder ends up reflecting more personal goodwill than another, then it may signal that they should be getting more consideration, which, more than their ownership percentage in the target. So you may like end up throwing off the numbers on that basis.
Yeah, I would say that the personal goodwill is an easy one, but if it changes the overall economics, it causes big problems. And the other issue that you have that's going on with all of this is even if you do a note or cash is you have indemnities that you have to give to the buyer. And now if you distort the ownership, you need to tell the owners how you still, at the end of the day, you need to be liable for your share, your proportionate share, even though you're trying to do things that are disproportionate. And that is a real challenge for owners to understand. And they get very frustrated by this process. And a lot of times what they really don't understand is if you just stay in there and you say, well, I want to get redeemed at a certain time. If one shareholder stays in and the other goes early, you have to tax affect the cost of that redemption because the shareholder staying in is going to recognize his proportionate share of the gain. And what ends up happening is the shareholder that stays in gets a basis step up and there's going to be an inside outside basis differential, but you don't recognize it till you terminate everything. So it gets really complex when you run the numbers, but I don't know if you have a different choice. You have to get them to really sit down with you all as the accountants or whoever's doing the numbers and make sure they have a firm understanding of the transaction and the consequences of it.
So I think the other option that's in here was the after tax, which we talked about earlier. And I think just going on what you said, Conrad, like another example of that may be, again, if you have the right fact pattern, and we had another deal like this at the end of last year where one shareholder owned like a fairly small amount and they could be redeemed out ahead of time so that there was only one shareholder remaining, and then that shareholder could go in and put whatever they wanted into on an after-tax basis and subscribe to the parent. But then you do get into, what is that redemption worth? Are they going to include, potential, if there's earnout in the deal, potential for earnout? Are they going to get trued up on an after-tax basis? Like, how do you make that work with making sure that they're getting their pro rata portion and value under the S Corp rules?
Yeah, we had like a 90-10 deal S Corp where you got 40 million coming through, but the 10% shareholder wanted rollover equity and the buyer wanted him to have it and the 90% guy didn't. And we had to take him out before we did the transaction, and all these issues came through. And the guy that we took out, because he had to pay after tax, we had to gross him off. But we thought that was the right deal to get him out. And again, numbers based and who represents each one coming to a deal. You would have thought it was like pulling teeth. It took a long time to get that done, but it took a lot of computations to get everybody satisfied that at the end of the day, they were getting the deal they thought they were going to get.
Yeah, all about the economics.
Yeah.
I think the other one that I didn't include here that people may be questioning is like, well, why don't we just do a 338 election or a 336 election? Because that way the buyer can get their step up in the basis, and then we kind of have a stock sale. So if you guys recall 338 or 336, you have a legal stock sale, but it's treated as an asset sale through mechanics. And I think the difficulty with that is, on the 338, first you have to make sure if it's going to be a 338 that the parent has a C Corp buyer, which is a requirement, although not a requirement for a 336E election that pretty much gets you to the same place. But then I think the tricky thing here is that the rollover can create related party attribution. And so 338 and 336 do not apply if you have a sale to a related party. And because we have rollover, this is really where it starts depending on the buyer's structure and the seller's structure and the amount of rollover going in. Because if you have a pure partnership structure, or if you have a C Corp in there, the way the attribution rules work under 267, you will end up with different results. So you really have to pay attention. And so oftentimes what we see is because of that attribution, because we have somebody going in and effectively under the attribution rules, they end up being treated as owning the substantial part of the buyer. So it makes it a related party sale. So it knocks out 338 and 336. But something worth checking if you have this as a potential option.
Yeah, you could own 2% and end up being treated as owning 100%. If you're the sell side, you don't care because you got a stock sale. Buyer's going to be really upset because they ruined it. So it just depends on who you represent in that.
Yeah. So because we spend a lot of time explaining this to clients who think this is stupid and they don't understand why they can't do what they want to do. I think when this article that Conrad mentioned came out, we all got really excited because we're like, this is like, somebody's figured this out. This is a way to do it. But then, of course, as always with tax, that excitement kind of gets scaled back because you do have to look very carefully at the particular circumstances. Again, back to the purchaser structure, the seller structure, and the tax attributes. And we're going to go through this in more detail. But like once you go through those numbers, I think you have to really work through to see if this structure is available and if it makes sense to the client. If sort of going through all of these machinations is worth it. And worth it once you actually, once again, like run the numbers. So the idea is that the sellers would do an F reorg of the target, and we'll go through those steps in a second. And then prior to closing, I'll just explain the F reorg quickly. So in the F reorg, you have your target company, the shareholders form a new holding company, they drop the target underneath it, the target makes a Q sub election, and the holding company continues the S corp election of the historic target. So you basically just have a tax-free reorganization, change of structure, and we'll go through those steps in more detail because there are some nuances that we can talk about in there. But basically, at the end of the day of the F reorg, you've got a holdco that owns the target, and then target converts to an LLC, and that way the buyer can purchase the target and have it in a flow through and it would be treated like an asset sale. They get their step up in the basis of the assets. So the target sets itself up for that transaction, and then this is a key. The holdco adopts a plan of liquidation. In step 3, it sells all of the membership interests of the converted target LLC to the buyer in exchange for, it says here 3 notes, but it's at least 2 notes. And how many notes there needs to be, I think sort of varies between practitioners, and we can kind of go through that. But the idea is that you have notes that qualify for installment sale treatment. So a portion of the note is sort of paid on a short-term basis, and that relates to the cash portion, and a portion of the note is more of a long-term note, and that relates to it's long-term note, and that's going to relate to the rollover. And again, we'll go through every one of these steps in detail, but just to set it up. So after the holdco receives those notes in the sale, it liquidates and it distributes those notes to the shareholders. After the liquidation, the purchaser pays the short-term portion of the notes. And then the idea is that the shareholders left with the long-term portion that they now hold directly, that they can contribute to the purchaser for their rollover equity. So now they hold it. Now they hold it directly. And it's a mix of S corp and installment sale rules that again we'll go through in detail in the next steps. But the idea is that doing it this way allows the shareholders to get their mix of cash and stock, to get their tax-free rollover, and to get the proportions that they want, and for buyer to get their tax basis step up.
Yeah, I think when you think about this from the business standpoint, is for the cash portion, if you're going to adopt a plan of liquidation, you need at least a day, right? Because we'll talk about, what the terms of the note for the immediate cash portion. I think what you have to balance if you have clients is what happens if the economy goes into a train wreck in 1 day or 2 days, and that's the risk you're going to take to save taxes? Or can you have the seller put the money in an escrow account that releases, you start tiptoeing around the whole structure. And I think those are some of the things that need to be considered for a tax savings in per se, and just thinking about it, because you have to at least have a delay in your payment 1 or 2 days, and we'll talk about that.
Yep. So diving into the details. So steps 1 and 2, or step 1 is the F reorg that we just talked about. So again, the shareholders form a new holdco. They drop Target underneath holdco. Target makes a Q-sub election. And usually we do a protective S-corp election for holdco because why not? I think there's sort of historically, again, been sort of practitioner debate on, whether you need that. And it may be, for example, if you don't have 2 shareholders, maybe you have 60 shareholders, then maybe you're not going to do the protective S election because it would require signatures from everybody. And if you feel pretty good about the S corp status, which, I think is sort of one of the things that we haven't talked about here, but one of the benefits of the F reorg is that it allows the buyer to get their step up in the basis without having to do their 338 election, which depends on S corp status. And it does remove the buyer. It doesn't get rid of the risk entirely, but it does kind of remove the buyer from, if you have S corp issues, which we know everybody has S corp issues. So again, the protective S election, because of that, is good if you can do it. But if it's just not practically feasible, then maybe it's just not worth it. So once you do that, then you convert the target into an LLC. And the idea with that conversion is the target is meant to retain the EIN as an LLC. It's meant to retain the historic EIN. I don't know what you guys have been seeing, but we've been, I think, having a little bit of difficulty, seeing difficulty with the IRS on them confirming that concept that the EIN transfers. So I think we used to either, there wouldn't be a separate filing for that because the conversion happens under state law. So it's not like a check the box election. It happens under state law. So there's no reporting that's done to the IRS. There's no specific form. So I think historically, we've seen that either nothing is done or maybe there's it's done through a change of name letter. I've been seeing more recently a suggestion that a protective 8832 is filed, so that it makes the IRS aware of that, and you have to include the articles of conversion and all of that. But as we know, I think the IRS is going through a tough time. So actually processing that and getting confirmations on those has been a little bit tricky. But it's important because one of the reasons that people want to do the F reorg is to retain that EIN because they need it for regulatory purposes or other reasons. So that's the goal. But that's just a little tangent because that's some of the issues that we've been seeing recently. So once we get through that F reorganization, and again, this is intended to be tax-free. So at this stage, if the deal doesn't go through, it hasn't really harmed the seller because Holdco just steps into the shoes of Target. That return continues. It just looks a little bit funny in that year because Holdco will have a different EIN. But there shouldn't be any change, and it would set the seller up for a sale in the future. And then Target becomes a disregarded entity under that. And the next step is that Holdco plans or adopts a plan of liquidation. And I think just practically, the reason for that, and we sort of have it explained later on, but the idea is that when you get these notes, 453H has a big exception for S corporations that, generally installment sale will be triggered if you exchange a note. But there's a really big exception to 453H that if it's in an S corp liquidation, that gain will not be triggered. But the plan of liquidation, there are a couple of requirements for that. And one of them is the plan of liquidation needs to be adopted before the sale happens. So this is something that you really need to be thinking about like earlier on in the sale process, because if you sort of get through the sale and are like, oh, shoot, should have done this. Because there are some other benefits to this as well, even if you're not doing the note planning. And you haven't done the plan of liquidation. I think people have been very sort of conservative in having a full out plan on this before the sale happens.
Yeah, I think the technical thing is the plan of liquidation. A lot of people forget about it. You just intend on doing the liquidation and then you're like, well, where is the plan? Or if you end up converting holdco to a partnership, the conversion is the deemed plan of liquidation. So you just got to pay attention to that. That's going to be one of the keys to all this because the installment sale.
Yeah. So then in step 3, the idea is that then holdco sells the membership interests in target for the notes. So note 1 is really intended to capture what shareholder 1 wants in terms of their consideration, and note 2 is intended to capture what shareholder 2 wants in terms of their consideration. And because of the installment sale rules, I think this is again where I think different practitioners will vary in their approach on these notes. You know, we want to make sure that it follows the installment sale rules. So we have a payment that's happening at least 1 year after the year of the closing. And so, you know, having maybe one note with the cash portion effectively being paid after the closing date, and then some portion being paid 10 years after the closing date, like, is that enough? We've seen people even split, like in our example in note 1, the cash portion is 8 million. So we've seen actually people suggest splitting note 1 into 2 further notes. So you have one note that's going to be for the rollover amount and portion, and then one note that's going to be for the cash portion. But even that note has a later in time aspect to it. So maybe the 8 million will be paid like 90% 3 days after closing and 10% in the next year to be as safe as possible. So then this is where like you really start getting into the complexity. You end up potentially having 4 notes, you know, just in the situation with 2 shareholders. So imagine if you have more shareholders and need more notes. And I think part of this may also depend on how our corporate folks feel on this and the particular circumstances of the purchaser. Because as Conrad was saying, if you have a buyer that maybe looks economically shaky, or if it's in an industry that you don't know where it's going, maybe you want to get as much of that up front and you're willing to take the risk on having just one note and having more of that cash paid up front instead of having some of it being deferred until a later year. And I have a note here, you know, or why do we need all of these notes? Why not just give them, you know, in a typical deal, if we get cash and we get a note, or if we get earnout, like we still treat the earnout bit being under the installment sale. And isn't that really the key to this? But the trick here on the cash and the rollover, and I can go through an example, is that when you distribute the cash and the rollover, there are some basis traps that you have to be careful of. And so that's the reason that we set everything up in notes instead of just getting cash.
Yeah, the thing she's talking about is, I think they call it the 453H trap in S corporations. At the S corp, if it has its installment obligation, and then if it turns around and distributes the installment obligation in liquidation, you have a different installment gain calculation that actually accelerates the gain faster than you would realize when you do that.
Yeah, so like a simple example, let's say you had a business that was worth $1,000 and you sold it for $100 of cash and $900 for note. So because you get gain on the cash, you pick up $100 of gain, that increases your basis to 100. then your outside basis to 100. So then when you make the distribution of the cash and the note, that basis is allocated pro rata based on the value of the assets that you've distributed. So you would end up allocating out of 100, 10 to the cash and 90 to the note, which means that now you've gotten $100 of cash with a $10 basis. So you'd immediately trigger 90 of gain. So instead of deferring 900, which was the original note, you're only deferring 810. So it would like claw back a little bit of the benefits of doing this. So that's why people set it up like this and make sure that you don't get a payment on the notes until after you've liquidated. So that's the key. But it is one of the things that I think you have to look at, because you may have excluded assets that maybe the purchaser doesn't want to buy. And so normally if we're doing an F reorg and we don't have to liquidate the holdco, those excluded assets might just be held in the holdco. But if we're liquidating it, we'd have to include those in what's being liquidated. So we might run into this issue even there. And then I think the other thing to think about is, for every single one of these steps, you have to think about what's going on in your seller. So we know that installment sale doesn't apply across the board. So if you have inventory, if you have traded property, if you have depreciable property, that's going to not be eligible for the installment sale. That's going to recognize the gain. And so you kind of have to work through how all of this is going to work and what gain would be triggered on the installment sale to make sure that you're getting the benefits. And there are also related party rules that don't allow you to get installment sale if you're doing a related party transaction. So again, something to look at. Usually we don't expect that to apply on just a basic rollover, but if you do have like a related party purchase, then this might not be available.
Yeah, I think the only thing on this slide to think about too is if you're deferring most of the gain, you're not going to get a PT, right? Because there's no pass-through any tax because it's deferred. And then the other people that are going to hate you are the state people. Because if you think about this, is the old trick that was used where if you had an S corp in Virginia and you sold assets and you had a Florida resident, you take 100% note for everything, you distribute out the note. Then the guy collects a note in Florida and says Virginia doesn't have any right to tax it because it's an installment obligation. So that's another thing you need to think about in here is that you're changing the state tax. There'd likely be no apportionment because you're deferring it all inside the company. Those are the things that are not talked about, but it might be right for a federal place. So keep that in mind.
So after step 3, this is kind of where we are. Purchaser now owns Target, and we have Holdco with note 1 and note 2. So step 4, if we've set this up, so step 4 is the liquidation of Holdco. So again, the reason that this planning is intended to work is under 453H. The liquidation of an S corp will not trigger gain on the installment notes. But again, you do have to meet all of the requirements. So it does have to be a 331 transaction, which we expect most Holdco liquidations to be. Again, adopt the plan of liquidation beforehand, and it actually has to occur within 12 months. So if you have a sale that is on pause for a while, may need to sort of regroup and like redo the plan if for some reason there's a pause. And I think even, if you're not distributing cash or excluded assets and you just have the notes going out, I think understanding the outside basis, if there is a higher outside basis, for whatever reason in the shares, and that outside basis gets allocated to the notes, does that actually give you, some additional benefit there? So instead of, if we weren't doing this planning, if we were just doing an asset sale and we sold assets, we get a note, we get cash, the cash increases the outside basis in the stock, And then the note later on in a future year, there's gain, it increases the basis in the stock again. You know, that's one thing that we always try to keep track of is that outside basis and when does it make sense, again, even without this planning, to liquidate the company. Does it actually make sense to liquidate it in the year of sale because you have so much outside basis that it actually offset the benefit of deferral under the installment note? Or does it make sense to leave that company in existence because the outside basis isn't that much and we can actually liquidate it in the year that the final installment sale is paid out, and take advantage of the capital losses there. So, you know, just going through this, even like in this planning, like still remembering all those numbers and how it's going to work out, is useful. But after the liquidation, then what happens is that shareholder 1 and shareholder 2 have their notes, and that note is still for essentially the cash portion and the rollover portion. So in step 5, the purchaser pays the short-term portion. So the shareholders get their cash. And that's when they recognize the gain on that piece. And so then what's left after step 5 is that remaining note that's effectively, again, for the rollover portion. So then the idea is for the shareholders to contribute those notes in return for partnership units. And this is, again, this is one of the sort of meatier steps in terms of what's going on here. So the idea is there is another exception under 453 that you can contribute installment notes in a 721 transaction without triggering the gain. But this is where you really need to pay attention to the purchaser structure, because I think the authors of the article were sort of lamenting that this structure isn't used, they haven't seen it used that often. And I'm wondering if it's because you need a particular purchaser structure. So here we have a purchaser parent and a purchaser, and those are both partnerships. Oftentimes what we'll see is we may see a purchaser parent and then it's just disregarded entities all the way down. And even though 453 gives you an exception under 721, there's a rev ruling, and I think there are proposed regs out there that are consistent with this, that if you contribute a note and it effectively satisfies the note and extinguishes the note, then you don't get to keep your installment sale treatment. You will trigger the gain on that. So if purchaser here is a disregarded entity, because it's all one entity, so if purchaser, if the notes are payables of purchaser, but you're putting them into purchaser parent and purchaser disregarded entity, you're effectively extinguishing them because it's all one entity. So I think that's where you'd have to be careful that maybe this structure could not be used in that purchaser structure. What happens if we have a C Corp? So I think if you have a purchaser parent, but purchaser is a C Corp, I think then you'd have a separation of taxpayers. But like one thing that I'm dealing with right now on a deal is purchaser parent is actually a Canadian partnership, and foreign partnerships are very careful about having US effectively connected income. So in those structures, you don't usually drop in your business or the note directly into purchaser. You have to go into the corporation first, get the stock, and then you drop the stock in to the purchaser. And so the question would be here, again, if purchaser's the original debtor on the note, and I have to do it into the purchaser first for a stock exchange, then have I just extinguished the note? I think there's a question of, well, what if you actually have multiple tiers? So you have a purchaser subsidiary, and then a purchaser parent corporation, and then you have a purchaser parent aggregator that's a partnership. Like, can you drop it into a consolidated structure? So even though there's maybe a deemed satisfaction under the consolidated rules, it still legally hasn't extinguished the note. And I'm sort of working through to see if that argument will fly. But I think the other issue with that is when you drop the notes into the purchaser parent, the idea is that the shareholders will have 704 gain. And so that will eventually be allocated to them. And Conrad can talk more about the timing, but if you're dropping that note into a corporate, that gain isn't getting allocated back to the shareholders. It gets triggered in the corporation. So effectively the buyer would have to pick up the gain on the note when it gets paid. So then question, could you forgive it in a consolidated structure in a way that wouldn't trigger gain? Or because the purchaser does get depreciation and amortization deductions, would those just offset? And can you just trigger the payment of the note at the same time as those depreciation amortization deductions would happen? So
I think high level is if you do this, the purchaser has to have another taxpayer underneath it for this to even have legs. If not, it doesn't work. And that underneath it, it needs to have another partnership or a C corp. And then when you contribute that note into that partnership to get the deferral, that's your quote rollover, you now have 704C gain on that note. So the problem is that's a real debt that either the lower tier partnership or the C corporation is going to have to satisfy by paying interest. And what it's going to do is you're going to end up recognizing a portion of the gain potentially every time there's a payment. And so you need to really be careful about using the traditional method or having something that if you trigger the 704C gain, you need to cover our taxes if you're going to do that. Because if not, you could be in a whole lot of trouble depending on the size of the note and what's going on in the purchaser entity. So, you now have, if you really think about it, you've done a sale with a installment obligation, a liquidation with an exception to the installment obligation, and now another exception to get the installment obligation in a 721 contribution. And now you have 704C. And like I said, we're starting to see a lot more of these issues. And I think Anna did put a good one. If you have substantial rollover and you have more than 5 million, you've got under the 453 rules where you have to pay interest on the amount that you're deferring. So there's just a lot of things that you have to think about in terms of doing this transaction.
yeah. And I think the other one here is if you have anti-churning concerns. So if you have a company that's been around before 1994, 93, then what we always have to be careful of if you have rollover, because again, the rollover will create attribution. You could be deemed as selling pre-93 intangibles to a related party, which triggers the anti-churning rules and which can cause the buyer to be deprived of the amortization they're expecting on the goodwill. So if we have a typical F reorg and the F reorg or the holdco ends up holding the rollover equity, that can, in some circumstances, cut off those attribution rules. But if you now have the rollover held directly by individuals, then you may have additional attribution rules that apply, and so may impact those rules. So you may need like a further tweak in this planning that, do you need to create an aggregator to hold those rollover units anyway? And maybe this time it's a partnership, so you're not dealing with these disproportionate rules, or do you have to create a partnership after you do the F reorg, so you're selling partnership interest instead of the goodwill, which is sort of a typical plan that we see to deal with the anti-churning, even if you're not, again, dealing with these rules. So, and I think as Conrad mentioned, also need to take into account SALT questions, if there's a difference in state and local tax. But I think I think this is a great idea and it's like worth checking out. But obviously, since we've spent like almost an hour on it, there are a lot of complexities on like every single step that you need to make sure that you go through and make sure that it actually makes sense for the client. And I think this is, very numbers based at the end of the day. So ideally, if you can do a model of, okay, what will this look like if we actually do this planning and have to take into account our depreciables and the PTID and the things that fall under installment and the outside basis and all of that, as compared to, okay, what if you guys just distribute the equity? Like, do you actually end up being in a better place that's easier, maybe at the end of the day?
This is what we all think about when we do these deals. And then a lot of clients are going like, why can't you figure this out in 10 minutes? I will say, we're starting to see the decks from the really large law firms utilizing this structure. And when you start seeing them, that means you're going to start seeing them more in the marketplace where they have people that want to get in and out of these transactions. So you will all probably see one and have to report one or do some analysis in one. And my guess is in the next year or so. Because when you start seeing them come out, it's like a flood, right? Everybody copies the deal. So I mean, do you guys have any questions or comments for us? This fantastic, most exciting presentation today, huh? Yes, sir.
A question on the installment sale rule, the 5 million, the interest charge, is that later down the road a credit or reversal at all? Or is it just simply lost? Because, you know, you record it as other taxes.
Right. I think it's just lost. It's what you pay. It's a cost for having such a large deferral. That's my understanding of the rule. Yeah, I mean, there's rules on it does an earn out count and how you do it. And that's, part of the analysis of all these things. But when you have some S Corp shareholders that do not get along, this is probably the most viable method to get them there. I think you've got to have a transaction for at least $20 million for this to work. Just because if you think about the transaction fees and everything that goes along with it. But if you have two people that really want a divorce, it might be worth 5, for doing it. So, I mean, that's it for today. Thank you. We appreciate your feedback. If you have any positive feedback or negative feedback, let us know. And I appreciate you driving here. For those that you came, please eat some more breakfast and have some coffee. And it's great to see all of you. And we're going to plan something, I think, after this season. And for all of you getting ready for the season, best of luck to all of you, because nothing's gotten simpler to my mind here. Take care. Thank you all. Bye-bye.